All righty. Welcome to the Utah Housing Market Podcast. Today we've got a special guest, Holly with Preferred Lending. We're going to go over lending rates and all that stuff. I'm Mike Rocaro, Mr. Utah Real Estate.
And I'm Jake Chase, the Dream Chaser. And this is episode number 4.
We're on episode 4.
And before we get started, go ahead and like and subscribe to our channel. We love your support. And thank you for joining us, by the way, today. We got some amazing information coming with our new guest that we have on this podcast.
Yeah, I'm excited to talk with Holly. She's here every week in our office. She's always giving us all the great information on mortgages, rates, what's happening in the market. So, welcome.
Holly rocks.
Happy to be here. It's always fun coming into the office. So.
Yes. Before we get started, give us a little bit of history about yourself. How long you've been in the industry, what you're seeing, that kind of thing.
So I feel like I've found this out the longer I'm in like the real estate sphere, that oftentimes people don't start in one portion of real estate. They like start someplace and end up someplace else. So I actually started in real estate with a real estate license and really enjoyed it, right? Was approached by another real estate agent that said, hey, I'm sick of lenders. I want like a lending company that is more directed towards agents and their needs and just a little bit more minded that direction. So she approached me and said, are you interested? What do you think about this? And I said, okay, let's do it. So a few years ago, I got my lending license in addition to the real estate license. And then within the last probably 2 years, I've shifted to almost exclusive lending and have really, really enjoyed it.
That's great.
Yeah, great to have you.
So you call it quits on the real estate side of it?
For you guys, yeah.
Okay.
I was going to say, family and friends, I have kept it active for me or like family or friends, but I don't like solicit. I don't really do anything with it. I can't remember the last time I actually did real estate versus the straight lending side of it.
So what attracted you toward the lending side of it? What does it say? Hey, you know what? I'm going to make that shift. I'm going to go over here.
For me, I think that's a loaded question. It's a time and a season, right? Like I have little kids at home still. So for me to scale my business, it is easier, and not easier, but it's less time outside of the home to work with a larger quantity of buyers if I'm doing lending versus working with buyers or sellers. So if I had 5 buyers at a time, I would be out of the house all the time doing showings and those types of things. I'm able to do that at home on the lending side a lot easier. Obviously, I like go into offices, I build relationships, I go to closings and all of those types of things, but majority of my job is on the phone. Yeah. I feel like. And so that changes everything. But what I realized I loved when I was doing real estate was the buyers. I love like helping someone achieve the American dream, and not to discount selling a house is great as well. But for me, that just made me so excited. And as a mortgage officer, that's all you do is help people get into homes or achieve their dream home or start a business with investing. And so I feel like, to me, it's more of like that realization of something new that really excites me. And I like being a part of that aspect of it.
Yeah, great reasons.
Yeah. I mean, I don't know.
Well, let's get into some of the current Utah housing market issues we're having right now. And I think the biggest issue probably for a lot of people, a lot of buyers anyway, is affordability and rates, right?
Yeah.
That seems to be the thing. We went into the 2s and the 3s 4 or 5 years ago, and then we went all up into the 7s and 8s, and now we're right around the 6s. So, it feels high compared to when we were in 2 and 3s, but in all reality, we're actually at the new normal. Does that sound fair?
Yeah, I think you can see it, especially in like the way rates have trended, where it was, okay, they're going to drop, they're going to drop, they're going to drop. And we have been so stable for such a, like, air quotes, long period of time, right? Where I feel like we've been hovering like that high 5s, low 6s. We've been there for a long time. And it seems that regardless of what's happening in the country or in the market, we like to stay there. Like there's a lot of resistance getting past that like high 5s. And so I think there would need to be a lot that happens to like break that resistance.
Yeah. And we dipped into those high 5s just for 3 days, right? So we came down right below 6, and everybody's like all excited, and then it came back up. into the sixes, and then everybody goes, "Oh, what's happening? What's going to go on?"
And at the time of this filming, we are in the middle of a war with Iraq. So I think that was some of the reason. And is that fair to say?
Yeah, so we started creeping when that all happened. But what's interesting is typically, like not typically, war doesn't necessarily
Sorry,
mean
not Iraq, Iran.
yeah.
Let me correct myself.
but it doesn't necessarily, like, war doesn't necessarily, or like conflict, right, doesn't necessarily mean interest rate increases.
Right.
But there are certain factors that do. So right now it's oil prices. The cost of a barrel of oil is affecting interest rates, and because they're looking at it as an inflationary measure, right? So it's okay, the cost of oil today is $108 for a cost of a barrel. Our rates are affected. So normally you would have your big Fed meetings and you have all this data that comes out, and then your market reacts to that. We're reacting to a lot of things right now, but the cost of oil
With oil.
is like very like indicative of where our rates are
So if we
shifting
can
right
get
now.
the oil thing under control, which it looks like they're trying to do, they're trying to get that all under control. If that happens and it goes back to new normal, do you see rates starting to come down again?
Ideally, yes. Like as long as those go down, and then you don't have anything else that spikes, right? Like inflation increases, our rates go up. But if employment decreases, our rates also go down. So like it's kind of this yin and yang where it's like if the economy is not doing well, you usually are going to see interest rates go down. If the economy is doing great, they're like, okay, you're fine.
So why is that, by the way? So let's just stop there for just a second. Why, when the economy is going up, right, and inflation is in place, then the interest rates go up? Why is that? Let's talk about that, because most people don't know why that happens.
Yeah. It's because it's all about what's traded, right? And so it's whether people are putting their money towards like the traditional market or the treasury bonds, right? Treasury bonds are typically a lot safer of an investment,
Yes.
right? And so when the economy is doing really well, the market also does really well. So people have a tendency to pull their money out of safer investments because their yield is better someplace else.
Yeah.
But then when the economy is not doing as well, people want and crave really safe investments, which that treasury bond is really safe. And mortgage rates really closely match what's going on with treasury bonds. Right. So like if you can look at the treasury bond and kind of see how it's trending, like if it's ticking up or ticking down, that's usually pretty indicative of where an interest rate is going to lie. Like if it starts going up, you're like, okay, our interest rates are probably going to follow. If it goes down, it's going to follow. And that yield spread is tiny. Like you're talking, like when we were in our low points, it was like 3.9, and now we're like 4.2. So it's like that has not shifted that much, but it's shifted our rates enough that people are feeling it.
Yeah.
Yeah, you know what's funny about that too is people think that rates for homes are attached to the Fed rate. You hear that, oh, the Feds are dropping the rate again. Oh, the Feds are down to 2. Well, how come my interest rate on my house isn't down? But you nailed it. It's not tied to the Fed rate. It's tied to the treasury bonds, right?
Treasury bonds, yeah.
So people don't understand that when that happens, and really inflation, how inflation works is if the economy's doing well, and all of a sudden that banana that you just bought that was 50 cents now is 55 cents. That's the type of inflation, and people don't realize that things go up. But one way to control inflation, right, is through the interest rates, and then the Fed affects all this, but the treasury bonds. But it's how safe people feel
with their like where they want to put their money.
Yeah, and that's why all the Feds with the bills and all the treasuries, they buy and sell them all the time. And we don't realize that as consumers is that the more confidence people have in the United States and in that backing of that note, then they buy more of them. And when they buy more, there's more of a demand, so that tends to go up. When they have less demand or they have more fear, that tends to go down. And so there's this like ebb and flow. And we've historically have had a 10-year cycle of all these cycles of the markets going up and crashing and coming down. But you know, it makes a big difference when you understand that dynamic, what you were just talking about, because when somebody comes to you as a consumer and wants a loan, I think it's a little easier pill to swallow why their rate is what it is. But if we're back to this normal of 6%, what can consumers expect over the next 6 months?
If we had crystal balls, we would all be.
Let me quickly add to the next 6 months part.
Yeah.
So not to get political or
No,
anything,
you're fine.
right?
Yeah.
But the current administration is trying to do some things to bring rates down. And he talked about over the next 6 months, what are you seeing? on top of that, is there anything that you see the current administration trying to do or doing that would help with that? And, is it should we wait or?
Oh, as far as like buying, like should we wait for rates?
Yeah.
No. The idea of waiting for rates to me is I'm like, you don't know. The best time to buy a house is if you want to buy a home or an investment property or whatever it is, and you can afford it, then why would you wait?
Correct.
So I am never a fan of I'm waiting for a rate because rates honestly to me, obviously a payment is directly respondent to that interest rate. But if you can afford it, who cares? But it is what it is, right? Like you know what you're getting into, and you can always refinance, and you just don't know what's going to happen. So I don't love people waiting on the sidelines because of a rate. I understand waiting on the sideline because of affordability, and to me those are two very different things.
Huge.
Because an interest rate you can capture whatever interest rate whenever you want. Like I have buyers that it's really, really important to them, and we're going to put cash towards this, or our seller is going to put cash towards this. So interest rates to me, I'm like, they change so much.
I just referred a client over to you who was at a 7% rate, right?
Uh-huh.
And she bought 2 years ago, and again, she didn't wait to buy. She captured the price.
Mm-hmm.
The rate was at 7%. She just went over to you, and you're going to get her at 6% right now. Is that correct?
Yeah. Well, and that's the thing that's interesting. So even someone like that, the interest rate right now that we're refining her into, that 6%, she actually could get a lower interest rate than that right now. So she could be closer to like
because of the refinance.
Yeah, she could she could get closer to like 5.5%. It's how much are you wanting to spend on this refinance? Mm-hmm. I don't love people spending a lot out of pocket. Like I try and get them to like the cost is zero, basically, right? Like we get enough lender credits to cover any type of closing costs. And that's kind of what I like to do with refinances. But the reality is she could have came in and said, hey, this is important to me. I'm willing to put more towards this rate. And she could have gotten into the mid fives or low fives or fours if right. People really want to. So for me, an interest rate is what it is, but it doesn't mean as much as people think.
Mm-hmm. Because they can buy it down like with a point or a half point or however that works. And just to kind of explain that as well too, most people don't know what's the difference between a point and a percentage. So we'll go over that with us real quickly, just so before we go into our next segment here. What's the difference between a point and a percentage rate?
Of like a 5% versus a 6% and like a...
No, I'm talking about like recurring versus non-recurring. So points are... they recur one time.
Oh, yeah.
And people don't realize that. So when I say I got to pay a point down for my loan, or you have these little fancy terms that go out there, it's like it happens one time. Yeah, it's where interest rate happens every single month.
Yeah,
right?
Yeah. When you were saying that, I'm like, wait, what are you? Okay, yes. So a discount, people will refer to them as like a discount point or a basis point or whatever, right? And it is a percentage of the loan amount that you're paying at closing.
Got it.
And so a lot of times people, it's super common in Utah, you'll see up and down I-15, like billboards with interest rates.
Is that legal?
Well, I mean, if you have APR, but the thing
they make it look so good on those billboards.
That's the thing, and it's not the whole story. And so that's what I want people to realize is that an interest rate that you see or someone quotes you, it's not the whole story. Mm-hmm. So until you see what discount points you're paying or what origination fees you have or what type of closing costs, it doesn't mean much. And I feel like I sometimes get myself into a spot with new buyers where I'm like, hey, I'm going to give you like this is kind of what it is at a no-cost loan. You're going to get lower interest rate options. If that's the case, come to me, and then we can actually tell you if it makes financial sense or it doesn't. Because a lot of times, like that interest rate it's flashy, and everyone's so rate sensitive that they're like, okay, well, a 6% is going to be way better for me than a 6.25.
Sure,
and that's not always the case. And sometimes the payments aren't even reflected. Like sometimes you can have a 6% rate and your payment is actually higher than a 6.25.
So you're saying there's a baseline and then people can add in or subtract or do change it up a little bit to have a little bit less or favorable terms, right?
Yeah, and that's the whole thing of using someone that's willing to take the time to go over all of that with you, because there is so much more that goes into it, and every buyer is going to be super specific of their needs and wants and desires, because again, some people might say, hey, it's worth it to me, I'm going to reduce this, and other people it's, okay, how much am I saving? I'm going to sell my house or I'm going to refinance. It's not worth that initial upfront in like cash to get that lower rate.
We kind of got away from the
I
original question of the next 6 months, right? Is there anything you see over the next 6 months that the current administration is doing, or anything you're seeing in your crystal ball that might be?
Honestly, the biggest thing is what ends up happening in Iran. If that resolves, interest rates should get better. Mm-hmm. If that extends, interest rates will react. Mm-hmm. It is nice that even as rates have increased over the last, like I feel like we were at our bottom, January, February, like that little, and then we started ticking back up. And the difference between the two spans of time, you're really looking at like 0.25 on average of a difference, which is not a significant difference in price for most homes.
Yeah, that brings us to one of our questions then of how much does a half a point really matter?
Depends on how expensive your loan is.
Right.
So on that, like average first-time home in Utah, single-family home is like mid-fives. The difference between a 6.5% interest rate and a 6% interest rate on that home with a minimum down payment. So this is kind of what I always use as my baseline, because I feel like, again, at your average price, single-family home, most people are going to come in with 3% down or 5% down or 3.5%, I guess, if they go FHA. So I'm basing this off of those terms, right? So first-time home buyer, minimum down payment, their payment will fluctuate between a 6.5% and a 6%, like maybe $170 a month. So you're under $200 a month difference in that half a point. Again, you talk about affordability. If you can't afford that $170 a month difference, you're going to fill it.
Yeah.
But if that's the difference between getting into a home and, hey, we aren't going to eat out 4 days a week, we actually are going to eat at home, and we'll save that $170 someplace else, and it's absolutely get into a home. Like if you're willing to make those other sacrifices, then do it. But everyone's different. Like everyone has different like wants and desires and needs. So
yeah,
you go down to affordability
And
versus the rate.
I guess your personal lifestyle too. If you're willing to change your lifestyle,
yeah,
a little bit, and not eat out as much, or not go to the movies as much.
Yeah, or I've had clients. I'm working with one right now, and they've been homeowners before, moved out of the country to help with family. They're back in to the United States, and they are like super motivated. And so one thing when we were talking about affordability is their payment, they qualified, but it's a little bit higher than they're like, hi, this is a little higher than we want to spend on a monthly basis. She's like, I'm going to sell my car. I'm just going to go get a cheaper car payment.
Yes.
Right?
Right.
And I love hearing that, because it's like, okay, you know what's important to you, but you have other people where they will not make that sacrifice because this car is more important to them.
Yeah.
Well, you kind of already segued into our next area,
Exactly.
which is
I was thinking the same
affordability.
thing. Yep.
So affordability was what we're going to tackle next. So we've already kind of started doing that. So I know there's a lot of different programs to help tackle the affordability issue, with buy downs. And the new thing, which is crazy because I've been in this industry 13 years and I've never, ever, until just recently, I've heard of them, just never used them, but ARMs seem to be coming back now, ARM loans. And what's some of the things that you're doing on the lending side to help with the affordability?
Okay, so, should we tell them what an ARM is?
That's a good idea.
So why don't you let us know what an ARM is, first of all?
Okay, so typically when you're getting...
A bicep, a tricep.
Yeah, yeah. It's this whole thing.
Don't forget the forearm. That's right.
But typically when you're getting into a home, you're looking at like the interest rates that you're seeing that people are quoting you is going to be a fixed rate, meaning that interest rate when you buy the house from day one, unless you refinance, that interest rate doesn't change. So if I buy a house and it's 6%, it will always be 6%. It doesn't matter if my loan is like changes servicers. that term, that interest rate never ever changes. So most people, when they're buying a home, they're getting a fixed rate 30-year mortgage. There are different loan programs, but they aren't frequently used. One of these is an ARM, which is an adjustable rate mortgage. So an adjustable rate mortgage it has a term. So a 5/1 is pretty common. And that means the interest rate that you buy your house at, it's depending on the economy, right? The ARM rates are going to look one way or the other. But say the adjustable rate mortgage, your ARM rate is a 6% when you buy the house at a 5/1. That means for 5 years, your interest rate stays at 6%. Then after you finish that 5-year term, your interest rate will adjust every year based on what the current interest rates are.
And is it usually prime rate plus?
Yeah,
some
plus
percentage?
like a eighth, so like 0.125 above what a prime rate would be. And a prime rate is an interest rate that you aren't paying for. So a lot of people refer to it as like a par rate. So when you're talking to a loan officer, it's, okay, what's your par rate? Meaning, what interest rate am I able to capture without paying any monies towards this loan or discount points or, right? Like we kind of go full circle there. And so there's different terms to these ARM loans. In the past several years, ARMs have not been as affordable or as good of rates as a 30-year mortgage. And so I think that's what usually pushes the industry on what people are going towards, because if an adjustable rate mortgage has higher interest rates, no one's going to use it. But if their interest rates are lower, now they become really attractive. If they're lower and people are saying, hey, this is my first time home, I'm only going to be in it for 5 to 7 years, it gets really attractive.
Especially right now where the interest rate is at 6%, and you're seeing a lot of, like, especially in the new home build segment things, you see these 3.99, you see these 2.99 introductory offers, or these, 5 or 7 year ARMs, like you're saying, or they have another one which is called a 2-1 buy down. And tell us about that as well, too. What does that mean?
Okay, so a 2-1 buy down is different than an ARM in the fact that your intro rate doesn't ever change. So if I bought at a 6%, and I also got a 2-1 buy down, so again, getting a 2-1 buy down, there is monies involved with that. It costs to get that buy down. So for a 2-1 is a reduction of interest for 2 years. You go down, so if I bought today at a 6% interest rate, my first year of payments, I'm actually paying a 4% interest rate.
Yes.
My next year in the house, I'm paying a 5% interest rate. At year 3, I go back to that 6%. But with a 2-1 buy down, your interest rate actually does not change. You are prepaying interest for that term. So I think that's the big difference. If you talk about affordability, so a buy down, you have to qualify for that 6% interest rate.
Correct.
Like, it doesn't matter that you are effectively going to be paying a 4% interest rate for that first year and a 5% for the second year. You are qualifying off of a 6%. But an adjustable rate mortgage, whatever that interest rate is, if it's lower than, right, like a prime
let's
rate.
say it's 4%. So you're saying, just to make it clear for everybody out there watching, that so the first year would be, let's say it's 4%, and then the second year would be 5%. And then after that, it would bump up to the full 6%?
On a 2-1 buy down? Yes.
On a 2-1 buy down.
Yep.
And then you talk about it costs, right? So just to clarify real quick, the buyer doesn't pay for this 2-1 buy down. We ask the seller to do that. The buyer cannot buy a temporary buy down, correct? It has to come from the seller?
Rules have changed. You can actually get money for a 2-1 buy down from your agent now.
Really? Okay, that's good to know.
And
Did you know that one?
So if you guys know, that's actually a new thing too. So if you need to talk to us, if you need to,
because they can put money towards that.
When you say the agent, how exactly? Like, I got to pay for their buy down now?
No, it would be coming from whatever commission that you
party commissions.
Well, and that's the thing.
Commission concessions.
Yeah, and I think that's the thing with working with a real estate agent that you know and trust. Like, these guys you guys are talking about all of these options. And when it comes down to even things like agent commission, it's I'm not asking you to pay my agent commission. I will negotiate my agent commission while I'm also negotiating the best option for you with this house.
Yeah. And that's why you see a lot of these new home builders as well, too. That's why it's more common because they'll give you a 3% back for closing costs, buy downs, whatever it is. And the home sellers, the new builds, the developers, they're going to be paying that down for you when you're buying a house. And so that's why it's very common in that realm. And especially now, see, new home builders don't need to do incentives when it's rocking out there, you know, but when there's a slow market, and that I always watch the new home builders, what they're doing, what's going on too, because they're always ahead of the game. They have to buy these loans and these big chunks to do their development. So they already have this kind of lender in place, you know, and for a while, some of them were like, you have to use our lender, but they can't really force you to use their lender. That's when they come to you, right?
Yeah. Yeah. Well, and they can, and that's the whole thing with new builds is a lot of times the incentives are not tied directly to their lender, like, but some builders are.
Yeah.
And so there are some where it's like, you can use whoever you want. You just don't have access to the full load of programs that we're willing to give you. But that's why I educate on this all the time, and my trusted real estate partners, where they tell their clients, hey, whether or not you go with this builder, let's get you a second opinion because she can look and make sure it makes the most sense. Mike and I did one like that where they had a really great incentive from the builder, and we were able to, they didn't give us 100% of that, but what they were offering really wasn't as good as what it seemed to be. But if builders, like right now, ARMs are really hot with some builders. The difference between a 2-1, if one offer is offering a 2-1 and one is offering a 5-1 ARM, I like the 5-1 ARM.
I was going to say, I'd take the 5-1.
Yeah, I'd take the 5-1. It's
all day long.
It's like, if you talk about affordability, that's it. You qualify for more because you're qualifying on that lower interest rate. Yes, it's nice on those 2-1 buy downs that you're paying less, but the term is shorter. Like, it's more of a rush to get into your next refi. And a lot of times with first-time home buyers, especially on FHA loans, you don't have enough equity, even at that 2-year mark, to be able to refinance without putting money towards your house.
And look at it this way. If I'm a new home buyer and I'm getting into a house and I got the 5-1 ARM, I have 5 years to get there. But what is the normal average, not normal, but what is the average time that somebody's in their house before they go buy another one?
It changed. It used to be 7 years. It's now 9 years.
Yeah.
So that's the thing. But again, a first-time home, I feel like, is a shorter term than that.
And with any loan, you know, whatever you get in at the current market rate, you can always refi into it, whether it's an ARM, whether it's you're doing a 2-1 buy down on a conventional loan or FHA. When the rate comes down to where you like it, you can always refine that, do into a new loan, a fixed rate.
Well, and that's the really nice thing too, like the difference between an ARM and a 2-1 buy down. Say you get into an ARM, a 5-1, 5 years comes and you haven't refinanced, and now interest rates are way higher. Again, if you work with people you know and trust, they should be talking to you before this point. You should be talking to them before this point. Hey, what do my rates look like? I know I want to refinance some point in this 5 years. But say you haven't, and interest rates now increase, but you qualified at a 5% and now interest rates are at 6%. You're going to have a hard time paying for that house. Where a 2-1 buy down, you qualified at 6%. You were eligible for that house at 6%. So you just get the benefit of paying 4% and 5%. But you know you always qualified at 6.
Yes.
Right? And obviously life happens and things change. But if you want to look at affordability, if you're getting into a 5-1, you're getting into a house that, you know, has the potential to be more expensive than what you originally paid. It's be sure you're staying in contact with your agent, with your loan officer, just to make sure you don't get into that position. Yeah,
and I think that's a big thing too. That, like you said, it went from 7 to 9 years on average people staying in the house, and I think a big part of it has to do with what happened in the market recently. We had these historically low rates, and who's going to sell their house at 2.8%, 3%? You know, some got in at one. They did their buy downs, and they got it all the way down to 1.9%, and it's like free money. So why would I ever move? Why would I ever sell my house? So that's tended to tipping these scales for people to stay longer in that case. So how are you seeing that now as we finally leveled out? We've had about 3 years of just really kind of, once it spiked and now leveling out. How are you seeing that? Because we're looking at, there's some things that we're going to jump into here in a second about buyer concessions, but now people are looking at moving and making that shift. What do you see that looking like in the Utah market here?
I feel like for the first time in a lot of years, we have shifted to a true buyer's market.
Yeah.
Which means there are more homes on the market than there are buyers, which also means people are ready to move. They've accepted that this is our new normal.
Yep.
Like, we're not going to see rates in the 2%.
Yeah.
Like, I don't think we will ever see those without concessions or builders doing something. Because I just had an agent tell me that they saw 2.99 with a builder right now. And I'm like, whoa, that's amazing.
Yeah.
Edge Homes. We just
Yeah,
talked
I
about
see that,
with
yeah.
Dave
Yeah.
last week. Yeah.
Yeah, and I'm like, that's incredible, right?
Yeah.
But
That's because it is a buyer's market.
yeah, yeah, right. Like they need people to get in these houses, but you're seeing that across the board. You're not seeing it just in first time homes. You're seeing it in the $700,000 market, the $800,000 market, the $900,000 market, the $2.5 million market. People are now accepting that it's like, this is our normal. This house no longer serves me. Like, it's time for something different. And that's the reality, is even when rates have been historically higher than they were over the last 5 or 6 years, right? Historically, we're not at this super high rate, but it feels like we are because housing prices have increased. But the reality is people always need to move for whatever reason.
Right.
You have
Always.
job relocations, you have deaths, you have divorces, you have all these factors.
Empty nesters, retiring,
yeah.
moving out of state, a new job. There's plenty of reasons.
And so you always have someone willing to move, but now you're seeing people that are wanting to move.
Yeah.
Right? Like, needing to move and wanting to move are different. I think there is a big influx of wanting to move. So there's all this pent up demand of, okay, I hated this house. I wanted to move 5 years ago. I'm just doing it. And that's awesome for buyers.
Yeah, we talked about rates, the affordability issue, rates, different types of rates, different types of loans. Let's talk about down payment assistance. What is down payment assistance, and how does that actually work? Who qualifies for it?
Okay, so down payment assistance is interesting. There are several programs out there. There's a lot of grants. Whenever I have someone that calls me and is asking about down payment assistance, it's a conversation of, hey, well, I've heard about X, Y, and Z. I've seen these grants. They're all good in theory, right? The one that is most consistently used and available across the board to most people, it's a program through Utah Housing. It's something that any of your mortgage brokers will be able to do. Only certain lenders have access to this Utah Housing, right? Your mortgage brokers are always going to have access to it because they are using a lender that has access to Utah Housing. Utah Housing is by far the most accessible, I feel like, down payment assistance program in Utah. And what it does is they have a couple different programs. One, you can have up to 6% in concessions, and so that's going to be the cost of your home times 6%, right? And then you're eligible for that amount of money.
So if it's $500,000, it's
I don't know. I can't do that math in my head.
$30,000, right? So, yeah. So, and then the average, what we're looking at here is $527,000 statewide. We're a little bit higher here in Salt Lake County in the sixes, but you're looking at somewhere between $30,000 to $40,000 in payment assistance, right?
Yes.
That's really huge for people.
Yeah, and
Big time.
and the thing is, so we talked about down payment is not 6%.
Yeah.
Down payment is on an FHA loan, which is that's what you're using with these down payment assistance program. You're not using a conventional loan. 3.5% down payment. So you have access to more than you need for down payment. And that's because it is also available to help towards closing costs.
Now, is there any regulations on this Utah Housing that I could rent my house out, or that I can do owner financing, or tell me what?
Great question.
Yeah.
It has to be a primary and you have to be living there. If you were to get out of your primary residence, if you want a new house, you cannot have two FHA loans at the same time unless they're extenuating circumstances, right? You have a big family shift, or you're moving more than 100. I can't even remember hundreds of miles away. But yeah, you can't have those programs at the same time. And Utah Housing it works as a second lien or a second mortgage on your home. So you have your regular loan that you would have on a mortgage, and then you have a loan for that assistance that you just received.
Right.
You can't do anything actually until that second loan is paid off. So you can't refinance, you can't move lenders, you're stuck until that one is paid off. And so you technically can refinance inside of Utah Housing, but Utah Housing's rates are higher than everyone else's because, again, It's
More risk.
It's more risk, and it's not a for-profit business, right? It's about getting people into homes. But it's also the reason why they're like, well, we lent you this other money. We need that paid off before you can then pull this loan from us to go someplace else.
Yeah.
So there are restrictions to it. But that's one program that you can use, like closing costs. You can get all of that covered. I say this because I say this to clients all the time. Down payment assistance doesn't mean you don't need any money. So in order to qualify for down payment assistance, you usually have to have money in the bank.
Yes.
The goal is not to use that money, but an underwriter wants to know that if you were to lose a job, you're able to pay for your mortgage. Yeah. And so there is that requirement is they are going to need to see some money. I get that question all the time. Hey, I saw this awesome program. I want to use it. Great. That's perfect. What do you have saved? And usually it's I didn't know I needed to save anything because I'm using this down payment assistance. And it's like, I don't want to use the money, but it has to be there. Yeah. And it's not a ton on an entry-level home, right? Think like $5,000 to $7,000 you probably need sitting in a bank account or a retirement account or something.
Which is not bad.
No, especially if you're talking about getting into a home. And then they have a second program that is down payment only. So you just are getting that 3.5%. If you go that route where you're just getting 3.5% versus the full 6%, your interest rate is actually better on that second mortgage. It's a really great option. But I also approach down payment assistance with a little bit of caution, especially with my buyers, with the understanding that if you need to sell your house in a year or two, you don't have any equity in this house.
Right.
So it's going to make that a little bit harder.
So you're telling me too, so I go and I get an FHA loan and then I go to Utah Housing and ask them for 6%?
Nope. So you do it all at once. So you go to a mortgage broker when you're qualifying. And the difference between a mortgage broker and a lender is a mortgage broker. I work as a mortgage broker. I do loans with, 30 different lenders. I have access to hundreds of different lenders. An in-house lender, they're offering loans just inside of their house, right? Like think of a bank, think of...
So they have just their programs they stick to, whereas you have 30 different lender programs you can go to.
Yeah, and so that would be something that you'd start with the very initial discussion. So whether it's an in-house lender, hey, this is what I need. Again, I'm not sure what banks and credit unions, if they have access to Utah Housing. I'm just not sure because I can't lend on them, so I'm not super familiar with those programs. But any mortgage broker that you approach should have access to a down payment assistance program.
Yeah.
Well,
Yes.
there's one other extra loan that is zero down. I kind of want to cover real quick. That's the VA loans. VA loans is also zero down. Explain a little bit what a VA loan is, and then is there other loans besides that also have
a 0%?
Yeah.
Yeah, so there are. A VA loan is obviously a loan designed for veterans, and they're great. So a VA loan is also, they're looked at differently across the board. So a typical loan, you have a debt to income ratio, meaning this is how much I make on a monthly basis. I owe this much on a monthly basis, and we do a ratio. And that ratio has to fall within a certain window to be eligible for that loan. A VA loan doesn't use the same debt to income ratios. They use what's called residual income. So they have a completely different chart that it says if you have one person in your family, this is how much money you have to have after expenses. If you have 2, 3, 4, 5, etc. But it's really nice because VA loans don't require you to put any money down. There's funding fees. Obviously, certain veterans are eligible to not pay that funding fee. Other ones have to. Like it's a whole thing. They're more complex than other loans, but they're amazing for veterans. And if you are a veteran and have never had a VA loan and you haven't even consider it because the benefits to them are amazing.
Now, do you have to be in service, or can it be insurance? How if your family member has served in the military or something like that, it's a VA loan. Can you qualify for a VA loan as well?
Like through your family, no. So it has to be the actual veteran that is the one getting the property.
Great.
And then Sorry, go ahead.
Well, you talked about that. It doesn't have to be the veteran. Let me just real quick. If a veteran and his wife or her husband, whatever, the veteran was to pass away and that loan is still on that house, does that loan still stay with that house?
Yeah.
Now that veteran is gone?
Yep. So that loan would stay on the house, which is
They're not going to be hit with anything.
nope. No. So, but you can't go get like kind of like that. What is it? USAA, the insurance that it's like if someone in your family had access to USAA, like all following them
All
have access
family-
to it.
My family actually does USA, except for I'm the only one. My father served in the military, and then all my family uses USA.
See, and that's what my grandpa served in World War II, and my parents he's like at retirement age, and he's like, oh, USAA would be awesome, but because my grandpa never used USAA, his subsequent family can't use it.
Can't use it, yeah.
So there you go. But yeah,
Totally different subject.
segue there a little bit.
We're not insurance salesmen, by the way.
That's right.
No, but there are other down payment assistance programs. So yeah, VA loans, 0% down. There are just regular lenders that will do a 0% down. You're paying a higher interest rate.
Sure.
And then there's I hesitate to talk about this, but there is a new program out there that has access on like regular loans up to $150,000 in down payment assistance. I just came across it because I had a client that was asking about it. There's only a couple lenders that have access to this program.
And you're one of them.
No, I'm not because I hate it, actually. I mean, don't come at me, but to me, if you're taking out that much down payment assistance on a home, you're not really putting any money into it.
Yeah.
Right? Like, you're not putting any money into it. You don't actually have equity in that house, and it's an equity sharing company, right? They're offering this down payment assistance, but they also are sharing in any equity that the house earns. Right. But guess what? If they put 150 into that house and you put 30, they now own the majority equity. Yeah. So you go to sell your house and you're like, this is great. I'm going to have like the benefit of owning a home is appreciation and equity. Yep. If you let someone else do that down payment for you, it doesn't exist. Like you really don't have the benefit of home ownership. It's like you're renting. Like, and that's like maybe callous and a little, but that's why I like down payment assistance homes on FHA first time home buyers because they're going to go pay off that second loan.
Yeah.
Right? Like it's $20,000. And that's how I approach it with my buyers. It's, okay, we're going to get you into this house. Instead of saving for your down payment before you get into a house, let's get you into the house that you want to be in, and then you're going to save for your down payment.
So this is a program that you wouldn't recommend?
No, I hate it. And that's why I'm like, I hesitate talking about it, but
it's good that consumers know about it because you can also get on the other side because there's reverse mortgages, there's other things like that may or may not work for you. But being educated and knowing all of it, I mean, we could talk forever. I mean, we haven't even talked about USDA loans either here. And there's so many loans out there that people can get that they can dive into. But it's nice to understand that even though I wouldn't recommend it because they're gonna have somebody told me I should get this loan.
Well,
right?
and it sounds. Oh gosh, that sounds amazing.
Yeah.
Yeah, it does.
It sounds
great. I can get into this $800,000 house that I wouldn't have been able to get, because I didn't have the cash to do it.
Yep.
And obviously, you're going to like that $800,000 house probably more than the $500,000 house. But to me, it just takes away the benefit of home ownership.
Yeah, and we're getting into the part as we transition into the inventory, what's happening here in Utah and how this will affect these rates and these programs. But one thing that we don't ever talk about a lot, and we would do some, but it's important to have the right people on your team, the one with the right knowledge, the right expertise, because not all lenders are created equally, and not all agents are created equally. Not all how many of you guys have had a contractor that come do some work on your house and they create more damage than they did when they showed up, right?
You hear those horror stories all the time.
Well, and even like you guys on the real estate side, like how many times have you entered a transaction and you've seen a name on the other side of the contract and you're like, ugh.
We've never felt that before, ever. Maybe they feel like that about us.
Something I do.
Maybe you guys are the ones they're moaning about.
Yeah,
no, whatever. These guys are pros.
Something I always do when I'm working on a deal is I always look up the other agent. And that's something you guys should do as well. When you're working with agent, look that agent up, see what they're doing. I always like to see how many sales have they done in the year, what's their history. And if I know I'm working with a good agent, I feel pretty comfortable. If I know I'm working with someone that's a little bit newer, maybe hasn't done as many deals, I gotta stay on my toes a little bit more.
Absolutely.
Well,
absolutely.
And I think that's the whole thing about being a buyer or a seller, whatever it is being educated in the sense that you want someone that you can go to with all the questions, but a true professional is going to answer those questions before you ask them, right? And if you aren't working with someone who can answer the questions before you ask them, obviously, like, everyone is going to have things that pop up, and your agent isn't, or your lender wouldn't have brought that up with you just because it wasn't on their radar.
Yeah.
But they should be answering questions before they're even a part of like your thought process, because it's like, okay, what do I need to know? I don't like think of it as I just use this because we're redoing our house right now. We're doing our cabinets, and I was reading this whole thing about like stain, like picking a stain color. A good cabinet maker doesn't say, "Hey, you pick the stain." A good cabinet maker says, "These are the stain options we have. If this isn't right, let's make something together." And it's like, we're going to talk about the process. We're going to talk about which things, like which stains to use, which brands to use. They're not going to say, "Hey, you go find it and then come back to me."
Yeah.
Right? And it's the same thing with loans. It's the same thing with realtors. It's, "Hey, let me give you all this knowledge. Obviously, you're going to have additional questions and we're going to tweak it. But I'm not expecting you to come up with those questions for me."
Yeah, it's funny you say that too, because as we transition into a buyer's market, they have more choices here. And we just crossed that mark here in Utah in some areas over 70 days. We're 71, 72 days on the market. And how does that affect the lenders on your side now that barriers are coming to you and saying, okay, so they need your more expertise, but how is that affecting you guys with the days on market being longer?
Well, it kind of goes hand in hand with your agent relationships, right? And it depends on when a buyer approaches me.
Yeah.
So if I talk to buyers before they've ever worked with lenders, our conversation looks different than if they're already working with an agent. And that's because we kind of talk about the market when they first come to me. "Hey, this is it." Or, "I've been looking online. This is kind of what I like. I feel more comfortable." People love getting a good deal. And in buyers' minds, a good deal is a reduction of price. That is almost never the best way to save on your affordability on your monthly, is reducing that price.
Yeah.
Like, money can be so much more effective in other concessions. And so it depends. Like, if I'm talking to a buyer before they've ever even talked to an agent, those are the conversations I'm having. "Hey, when you're looking, have these conversations with your agent. Say this is important to you. So maybe you're only focusing on homes that have been on the market a little bit longer, because that's what's important."
Yep.
You hit on exactly what I was going to bring up next, the concessions part. The affordability, we're going into the more inventory on the market right now, which helps with the concessions, right? So not only did we talk about the different ways to help with affordability, seller concessions is another one that is very popular right now. Something with this buyer's market that we can, and home sitting on the market for 70 days. Seller concessions can also help. And with seller concessions, what kind of things? So we would ask the seller to contribute something back to the buyer. "Let's get your home off the market. It's been on here 70 days. We'll help you do that. Give us something in return, and we can use these concessions for."
The biggest one is, people are always going to say closing costs. I use, most of my agents, when they're asking for concessions or these credits from the seller, right? It's the seller saying, "Okay, our house is listed at $500,000. You're going to buy the house at $500,000, but during this transaction, we're going to give you 2%, right? So that's 10 grand. That's math I can do in my head, right?
Good job.
It's $10,000 that you can use. And there's an agreement, an addendum that says basically the buyer can do whatever they want with that $10,000.
Right.
That's my favorite one, because then as a lender, I say, the agent comes to me, "Hey, I got you $10,000. How do you want to use it?"
Yeah, because a lot of them will try and get the price down $10,000, but I'd rather take $10,000 and buy the rate down.
Yes. Yeah. So on a $500,000 property, right, a 2-1 buy down is going to cost, I don't know, 10, depending, right? $10,000 to $13,000. And sometimes less, sometimes more. It right. If you use that 2-1, so if I'm going from a 6% to a 4%, I'm saving effectively. Again, your interest rate isn't changing. Your effective mortgage rate, I'm using air quotes here, is changing because you you already prepaid that interest.
Yep.
You're really saving like $600 to $700 a month.
And that's huge.
That's huge. You know what happens if you reduce your purchase price by $10,000? It's like
$25. Yeah.
yeah, I would say it's like next to nothing.
Right.
You will never feel that savings. And so you get there and it's okay, how do we like what is the most important? And again, I've had buyers where they don't want a 2-1 where they say I just want to reduce my interest rate by $10,000, right? Like I'm going to spend all that $10,000 towards lowering it into a permanent rate because a 2-1 buy down is not a permanent reduction.
And you're going to pay that interest anyway because it's all front loaded on any 30-year amortized loan. People don't realize how front loaded it is. You don't really get the benefit. It's still somewhere between that 8 and 9 year years of paying that it starts to shift, right? So whether you hang on to it for 7, the thing is in our society what's happening, if we're moving every 7 to 9 years, we're always going to have a loan.
Yeah.
Yeah.
Versus back in the day when you bought, that was your forever house. You lived there until you died. And so you pay it off somewhere in that, 25, maybe 30 if you were paying on time and being a good person. And now we can actually pay a lot more, and we've figured things out as more sophisticated borrowers that we can pay a 30-year note off in 15 years.
Yeah.
By tweaking how often we pay it and when we pay it of the month.
Well, I'm like, you could get into so many things. Like you can have first lien HELOCs now.
Yes. Isn't that awesome?
And you can pay your mortgage. You can pay a 30-year off in, 7 years.
Yep.
With like that is a whole different.
We should do a segment on that because you can become really wealthy. Within 5 to 7 years, you can have your, like you said.
It's crazy.
So we'll talk about that.
Yeah.
Comment in the comments below if you want to have that as our
because that is like
Yeah.
next level that you can really jump into it. But that's the whole thing is I think what it comes down to is people feel your mortgage, and so don't get distracted by an interest rate.
Correct.
And then not only with the concessions, you can do the rate buy downs as well, but there might be someone that's like, I'm okay with the rate. I just don't want any money out of pocket.
Yeah, and that I talk about liquidity all of the time. And that's okay. Is your money more valuable to you in the closing costs of this house, or is it more valuable to you in the savings account it is in or the market account, right? Because closing costs don't go towards your loan balance. It's strictly a cost. It's a cost of buying the home. And so that's not built-in equity. That's not like it is what it is. It's just gone the second you do it. It's a necessary evil. You have to do it.
Right.
But that is that conversation then where it's, okay, I'm good with my payment, but I don't want to take any money out of my account other than my down payment. And you can, and here's important to note, you cannot use seller concessions to pay your down payment ever.
Right.
That money can never go
They
towards
say
your down
that you
payment.
can. Some people advertise it, but you can't.
Well, you talk
Yeah.
about the different things you can pay with concessions. Correct me if I'm wrong. With VA loans, you can pay additional things that you can't with other loans. Like you could pay off some debt. Is that correct?
Probably. I don't know. I like.
If you ask for concessions.
I would say don't quote me on any of the VA ones just because I'm like, they are so. A VA loan would be like if someone came with that and was like, hey, I would be going to the guidelines just because it's not something that's coming
Sorry,
up.
I got you into the...
No, I like I'm the first to admit like, and I tell this to clients, I'm like, if I don't know, I will get the answer for you. Like there's guidelines for a reason because there are just extenuating circumstances or there's things that come up. We were just talking about a bankruptcy with someone. There are extenuating circumstances that I'm like, they're like the guidelines are pages and pages and pages and pages and pages. And it's one of those things that it's, if something specific comes up like that, hey, can we do this? Can we not do this? Yeah, let me look into it and I will tell you because I don't ever want to get you into a position.
Yeah, and don't take what I just said for check with your lender and make sure. I mean, every situation is different.
Well, yeah.
Every buyer is different. Every loan is different. Every house is different. Every location is different. So, yeah.
And this is why we bring like Holly in here, right? To bring you in because you're the expert in that realm. You know, if I'm not an attorney, I don't give attorney advice. If I'm not a
Right.
if I'm not an accountant, I don't give financial advice.
I'm not giving lending advice.
Yeah. Well, and that's the thing, right? I'm like, that should be something that it's like right off that is like, yeah, we can do X, Y, or Z. I'm like, I'm never going to come and say, yeah, I had someone that did this, and so I know for sure.
And there's different programs that pop up all the time. We talked about the one that you didn't like.
Yeah.
Right. There's things that pop up all the time. Things change.
Well,
and
yeah, like
regulations
guidelines
change,
and like it's like a fluid market all of the time. And so that's why, again, it's important to use someone that is doing continuing education, that is actively doing loans, actively doing real estate, because things just change. But ultimately, like it comes back to working with people that you trust, and again, are answering questions before you have them. Because if I talk to someone that in their mind is, it makes the most sense to, like, I just want a good deal. I want to pay $540,000 instead of $560 because that sounds like I got a good deal, and they have that in their mind. It's actually really hard to convince them otherwise, that that's not the best use of their money. Like I literally just had one. He's buying an $875,000 house. I'm going to offer $860. And I'm like, don't. Offer $875 and let's get $15,000 from the seller in these credits. It's gonna help you way more. No, it's better. I'm gonna get $860, and I'm like,
you guys would be surprised at how much a $15,000 concession will help with your affordability versus a drop in the price. It's just amazing. Like, why? There's no reason to lower the price when you can get that concession.
Yeah, you know what's funny about that too is that people don't realize that as a buyer, you look more attractive to the seller offering it that way too, because now they see the $875 versus
full price offer.
Yeah, so it makes a big difference when you're doing it, but you look at a win-win on both sides. Like, people feel like they get the value because they got the down payment assistance, and if you're the seller, you got the value because you sold at full price. Yes, you gave them payments, but you're going to pay things anyway.
Well, and like that's the thing too, is I think sometimes when you're offering less than offer, it comes off offensive, right? Where it's like, you think my house is gross? Right. No, I don't think your house is gross, but I need help affording it, right? So if you ask for affordability concessions, hey, I need help with these closing costs. Like, I love your home is beautiful. I love it. Like, I want to give you full price, but I need help affording it, and that's the market we're in. Like, people are craving. They need help with affordability.
Yeah, and speaking of affordability, one of the biggest things we have new home buyers coming into is market's changing. We have the younger crowd that's actually coming into the market, and then we have everybody that's been sitting on the fences for a while waiting for the interest to come down, right? So now all of a sudden there's this going into. So a couple things that I want to ask you here too, because what are a couple things they need? And we just went through this with the client. You know, one, you can't pull your money off your credit card to put your your down payment or your earnest money deposit down or anything like that. So make sure you have money first. But what are, the top 3 or 4 things that brand new home buyers need to position themselves to come and be successful and bring to you? Say, okay, here's what we're going, so I can get pre-qualified.
And I'm ready to buy.
Yeah, exactly.
Knowing your credit score is really important.
So credit's number 1. So know your credit score.
Well, I mean, and maybe not number 1, but it is extremely important. Okay. What you're seeing on your credit card statements or Credit Karma or whatever it is not actually what it's going to pull up on a mortgage search.
Well, my bank account, my bank has this little FICO thing that I can check every month. Does that not matter?
Yeah, keep checking it. Okay. And it is important.
So FICO's kind of like the Zillow kind of thing.
Yeah,
right?
like
you go on the Zillow and here's the price. When in all reality, they've overpriced it so that you keep coming back to look at their Zillow website.
Yeah, and when you qualify for a car, it's different. It's these algorithms that the credit unions use. Yeah. So they use a different algorithm when it comes to mortgages. So if you have your FICO score and you're seeing an 800, expect your mortgage credit score to be lower than that. It's going to be if you have a good credit score, it's still going to be good. But if you're on the cusp, important to note, you need a 620 credit score to do down payment assistance with Utah Housing.
Right.
You're not going to get it. That is no way around it. You have to have a 620 credit score.
Yep.
So if you're looking and you're 630, I would start hiking it up because there's a good chance your mortgage pull is actually going to be lower than that. So being aware of where your credit score is and why your credit score is doing what it's doing. A lot of people, I have someone I'm working with right now. She had gotten herself into a little bit of credit issues a few years back. Thought, I can't use credit. I'm not responsible enough to do this. So she now has no debt minus her house.
Yep.
But she wants to get qualified for a new one. Guess what? She stopped using credit. So
And when you stop using credit, what happens?
it doesn't help you much.
You don't have no record of using
You lose
credit.
it. You lose it.
Yeah.
There's no
Same
record of
thing.
using
Same thing
credit.
happened with me when I went to Mexico. I stopped using credit. I didn't need it down there,
Mm-hmm.
And all of a sudden, if you don't use it for 6 months at all, then they go, how do we track it?
Well, and you get that too with people that are really high wage earners, and I use cash for everything.
Yep. Huge.
Why do I not have an 800 credit score? I'm making a ton of money. I have like I'm great on paper. Fortunately, they want you to use credit to show that you know how
have
to
a car loan too. It's like what? I
yeah.
have to have I've never had a
Yeah.
loan on my car
Yeah,
before.
they want you to have installment loans. They want you to have mixed credit.
So credit score is how are you using credit?
Yes, it's like how responsible are you with it, and it's a huge part of that is credit utilization. So meaning if you have a credit card that has $1,000 available balance to you, and you're using $900 of that $1,000, you now are using 90% utilization. Your credit score will tank.
Yeah.
You want to be using under 30% of your usable credit. So if you get into that position where it's my credit card only has $1,000 on it, I am consistently using $500, $600, $700, $800, $900 of that usage. I may be paying it off every month, but I'm still using it. Go to your credit card company and ask for a credit increase. Like that's the easiest way to lower your utilization is asking for an increase. Again, you're not using it. You don't want to use it, but it's just showing that you're using less of what's available to you. It means this company trusts me. They know I'm using my credit responsibly, and a credit score will reflect that.
And how often can you ask for a credit increase?
It depends on your institution. A lot of them on the apps now will say request an increase. And
Great.
you can click on that button and you request it, and they will either say yes or they'll say no. If they say no, no harm, no foul. If they say yes, great. You're automatically using less
Yes.
like credit. So yes, responsibly using credit, paying your credit cards off. If you can't pay it off in full, hopefully you can pay it off in full. Like that is the whole point. You don't use credit. You use credit like cash, right? Like you're only going to use it if you have the cash to back it up. That's not always the case. Say it's not the case. If you're using it to max capacity, at least make sure you're making your payments.
Yep.
Like, don't have any lates. Installment loans, don't have any late payments. Don't use a ton of your credit. And just that responsible over time will increase your score. There's also programs that you can import, like your internet bills, phone bills, things like that, and that can help increase your credit score as well because you're paying those regularly.
How do bankruptcies and short sales and foreclosures affect and the timeline on those?
It depends on the type of bankruptcy, actually. So some, I can't remember, Chapter 7 and Chapter 13 are treated differently. Honestly, safest rule of thumb is 2 years past discharge. So if you've been discharged for 2 years, you're going to be eligible.
For FHA, but for conventional, it's 4 years, right?
Yeah.
So but it's important to know too, because if you go through bankruptcy or something happens, you can qualify for a new house FHA in 2 years. However, if you want, let's say you are making a bunch of money and you need like a jumbo loan or something like that, that doesn't really qualify. Now you're into another category. So people need to understand: is it 2 years? Is it 4 years?
Well, and that's the thing too. It's if someone is really motivated to get back in, it's, hey, I was discharged 2 years ago. Great, we'll throw you into an FHA, and it is obviously FHA has loan limits, right? Like you're not going to be able to get an $800,000 house unless you have a lot down to reduce you back into those loan limits. But it's okay if you want to get in. Sure, we'll get you in with an FHA, and then in 2 more years we can put you into a conventional loan if you want to, right? Like so, there's ways around it, but credit score super important. Income, know what you make. A lot of people don't know what
Isn't
they
that
make.
crazy that they don't know what they make?
Yeah.
They better be doing their taxes because they don't know how much you're making, right?
Yeah, well, and knowing where that income is coming from. So an underwriter looks at income differently. So a W-2 earner, which is most people are going to be W-2s. That means at the end of the year, you will get a W-2 form. If you don't get a W-2 form, you're not a W-2 employee. But that amount on your W-2, so say you get your W-2 at the end of the year, you have $70,000 on it. Okay, where did that $70,000 come from? Because that's not always what you're qualifying on. So it's being aware of how you're getting paid, when you're getting paid, where that money is coming from. So if you're getting bonuses, if you're getting commissions, if you're getting overtime, if you have like pay differential, those are looked at differently than your regular hourly earnings. Those are looked at differently than a salary.
So they're weighted differently. For the loans.
Yeah. So if you are working in a W-2 job and you get bonuses, like I have a client right now I'm working with, they get huge bonuses. It's like more than 50% of their income is bonused. Thankfully, they have 2 years history of receiving that bonus. So an underwriter will let you use it. They'll take an average. They take the lower average
do they average
of
it out?
Yeah, they'll take the lower. They'll look at like 2024, 2025. If it's increasing, they can take the higher amount, right? But they always are going to take the most conservative number. If your bonus decreased, they're averaging it out, but they're probably just going to take that lower amount.
Take the lower one.
The W-2 employees, and this is kind of a two-part question now. You got the W-2 employees, right? You got the 1099 self-employed. Is that different? The qualifications to qualify for the loan, is that different than a W-2? And this happened to me. We talked about this when we did our last podcast. This happened to me. I'm a 1099. I wrote off everything.
Yeah.
I wrote off everything. And I went to refi, and I couldn't refi because it looked like I made nothing. So for a 1099 employee, self-employed, what's the best route for them to get qualified?
Being aware of when you want to buy. So if you want to buy in the next you have to be forward thinking if you're 1099 employee. And there's no way around that.
So what would you recommend?
Talking to someone, say, hey.
Don't write off.
Well, that's the thing. I would push you to a CPA.
Yeah,
I would tell
talk to your CPA. That's
talk
important.
to your CPA, but talk to a lender as far as what does it cost to what would my mortgage look like at this price point? This is what I made last year. What if this was W-2 income? What would I qualify for? Great. How much is that payment? Great. Then you take that to your CPA and say, hey, this is what I needed to earn in order to afford this house.
Yeah.
And they take care of that. I don't take care of that. Don't call me and say, hey, what do I need to put on my taxes? But you can call me and say, I want to buy a house. What does this cost, and what are the debt to income ratios on that?
That puts us into a whole different realm when we start talking about taxes and accounting.
Well, yeah, and that's the thing. Even you go back to a W-2 earner and a bonus. If you didn't know that wasn't going to be looked at the same as your salary, you come into it being shocked that you're not eligible for what you want. And it's the same thing with overtime or 2 jobs. You'll get that with people that are working multiple jobs. Well, why can't I use income from both jobs? Well, there's rules. If you haven't worked at both of those jobs for 2 consecutive years with an FHA loan, we cannot use both.
Right.
If you have more than a 6-month gap, guess what? We can't use that other job. And
what were you doing the last 6 months?
why'd you quit? And so that's the whole thing is, and I think you would think it is an easy thing to, if you're going to buy a house, have some forethought, but that's not always the case. And so if it's something that you want to do, talk to someone now. Even if you don't think you're ready, talk to someone.
Yeah,
that's great.
Before we close this whole thing up, though, real quick, buyers thinking about buying. So I've had this happen a few times. We had a client together. This happened. They went to a lender, and this lender said, "You don't qualify." And I said, "Wait a minute. Let's try that again." The one that did the townhome, right? The builders lender, because they had incentives, and the builders lender said, "Yeah, let's get you in here." Looked at him and said, "No, you don't qualify." And Holly's like, "Wait a minute. Yes, they do." Gave it to Holly, and Holly says they absolutely qualify, and I can actually help with this incentives that the builder's lender have. So, moral of the story is if you go to a lender and they say no, go to another one and ask them. And if they just come to us and let's shop a multiple different lenders, because everyone has different programs, and we can if you make the money, have the credit, we'll find the way.
Huge. What? That's so important. What he was just saying, because we get told no so many times, but we are afraid to go ask again somewhere else.
Right.
If you want it bad enough, you'll find it how to do it.
Yeah.
I've had that actually happen multiple times, actually. That a buyer has come to me and says, yeah, we want to buy, but our lender says we don't qualify. I was like, well, let's try one more time. Let's see if someone else can qualify. And it has. It's happened, and they qualified.
It's happened to me a couple
and
times,
they're
too.
super excited after, like, oh my gosh, thank you.
Yeah, and it's just because people, again, it's those questions, right? Like, you want someone that is digging more into it. Okay, why didn't you qualify with this other lender? Let's do a little more digging and figure out a way. Or sometimes you'll hear scenarios and it's like an automatic, oh, there's no way. Like, I had a buyer right now, she's 560 credit score. Very little income. Oh, there's no way. Like, she's going to get qualified. You're going to have to manual underwrite that loan. And no one wants to manual underwrite. Like, they were extremely hard. And I say no one, like, I wouldn't do it. Like, the lenders are doing it. But they don't want to do them because they are so hard.
That's why they tell them no.
Yeah, they tell them no, right? Like, they want this. It's called AUS. It's an automatic underwriting system. They want AUS approval. Get this scenario, and you look at it, and you're like, there's no way. 560 earning, annually $40,000. There's no way. Well, she's qualified. We got her approved, right? And so it's just knowing how to, like, what type of compensating factors do you need to put into place? Like, it's not manipulating the system, but it's putting the right things into the system that are going to be weighted to get that approved.
You know the whole picture.
Yeah, you're not shutting it down when you talk to someone that, hey, this is where I'm at. Okay, let's dig a little bit more. Okay, can there be a co-borrower? Do you have a down payment? What does that down payment look like? Guess what? She had a huge down payment. Changes everything.
Interesting. That's really great. Well, Holly, this has been great. This has been fantastic having you on our show today. And is there any parting thoughts that you would say, step 1, step 2, and thanks for listening to Holly?
No, honestly, I would say take interest rates with a grain of salt. Like, don't be drawn in like a fly to a flame with a pretty shiny interest rate number. Talk to someone that is actually going to go over everything with you, because again, an interest rate isn't always reflective of what your price is, and like, get to a professional that is willing to take the time to go over everything with you.
And not only is Holly an expert in this, she is also one of our preferred lenders on the UtahHousingMarket.com website. Go on there, check it out. We've got all this information on there, plus a lot more. She is one of our preferred lenders. We've worked with Holly for quite a while now, and she is amazing.
Yeah. She's also a preferred lender in Real Estate Essentials here in the office, which is great.
She's at the top of her game, and so many times that she's saved a deal for me.
And it's because I will say, I don't know that. Let me find out an answer.
Exactly.
Right, exactly. Yeah.
Which is really good.
Well, thank you again, Holly. It was
Happy
a
to be
pleasure.
here.
I always love having you come into the podcast room with us and talk shop. And thank you, Jake, again. And don't forget, you guys, subscribe, hit that thumbs up, leave us a comment, let us know what you guys want to hear more of, and we'll make sure we get that covered.
Thanks, you guys. We'll see you next time on episode 5 coming up.
Yes.
Next.
Thank you.